You're watching Global Insights with me, Punita Kumar Sinha. In the last episode, we discussed the future of the Indian economy, the potential and the risks. We spoke about how the fall in commodity prices has helped improve India's macros. But the key question that remains, are lower prices the new reality for commodities? Here's a report on the state of affairs right now from Sriram Iyer.
You paid $140 for a barrel of oil in 2008. Today, it's down to a little over $40. While oil hogs the headlines, even other commodities, copper, nickel, aluminium, agri-commodities, you name it, and each one of them has seen a rout like never before. The IMF Metals Index, a global benchmark, took 17 years to break out of a range in 2005. A glorious rally thereafter, led by an infrastructure boom in China, has now fizzled out. The index is now back to 2006 levels. A significantly slower economy has been the bane for all commodities, as demand has taken a big hit. In the case of oil producers, the shock has multiplied by the emergence of shale energy in the US as an alternative, while for net importers of oil like India, this has been a timely boom. Traditional oil producers have had to tighten seat belts and halve the price in just a few months. The road ahead doesn't seem any smoother for any of the commodities, while the likelihood of another China-like infrastructure boom anywhere else seems almost next to impossible. The global recovery at large is expected to be a slow, tedious one, and therefore consumer demand is likely to remain subdued. The jury is still out on at what price level shale producers will be rendered uncompetitive. To say the least, the world of commodities is in a state of flux. There are many questions and the answer is elusive.
The three questions we are asking: will commodities remain in a bear market? What is the new normal for crude? And what will revive the commodity slump, and when? Joining me today are Roberto Aguilera, Research Fellow, Curtin University, Australia, joining me from Vienna, and Colin Hamilton, Head of Commodities Research, Macquarie, joining me from London. Gentlemen, good to have you on the show. Colin, let's start with you. My first question is, do you think the commodity meltdown is reflecting the underlying fundamentals?
Certainly. In terms of commodity markets, what we have is some pretty simple problems. We have too much supply, and we just don't have the demand growth at the current time to grow into that supply. You add that with the fact that China is weakening, and you get to a situation where supply and demand fundamentals are out of balance, and we are trading to a level where we're quite frankly trying to get rid of supply at the present time. I would say where we've traded to over the past little while is reflecting current market fundamentals. The question now is whether that demand can actually come back and lead to better commodity pricing in the future.
But just the last decade, everybody spoke about the super cycle of commodities and that the emerging market demand was going to remain strong with better demographics and better living standards. Why has that suddenly all changed?
Well, I think the super cycle, if you want to put it that way, is still on. We're still looking at demand above the 30-year norms. Unfortunately, that demand super cycle was more than outweighed by a capital investment super cycle. Let's take the metals and mining industry. We've had two very strong capital cycles in the past 5 years, upstream from mining companies and downstream from China. The net result is too much productive capacity, driven by higher margins and freely available money. Now we're struggling to grow into that capacity. Now, emerging markets are still that driver of commodity growth. It's just that driver is in a slightly lower gear than it was 2 or 3 years ago.
Roberto, the same question to you. A few years back, there was talk about the commodity super cycle, oil included. Is it different this time?
Yeah, some of those big commodity cycles in the past were demand-driven. I think what's happened this time, supply has played a big factor in bringing price down. We saw high levels of about $100 over the past 4 years. That was because supply was actually having a tough time keeping up with the strong oil consumption that was being experienced primarily in Asian countries. But this time around, price did come down, and that was can be mostly explained by the unexpected nature of production. which it turns out has been higher than people were realizing as it was happening.
So do you think supply can kick in now as it did then?
It didn't kick in then because it's been annual growth and large annual growth of well over a million barrels a day. And it took several years. You know, in 2014, you saw such high growth, most of it explained by rising output in the US, which was surpassing 9 million barrels a day, similar to the peak that they had back in 1970. And that's when finally prices came down. And as I said, demand was also slowing down around that time due to disappointing economic growth around the world, but particularly in the emerging economies.
Colin, turning back to you, do you see prices increasing given that, as you said, emerging market demand is still high and above the 40-year norm? And, you know, supply is also at some point going to stop given that the costs are prohibitively high and the capacity will have to reduce given that, you know, it's not profitable for companies to actually produce anymore.
I think it's going to be very hard to see pricing of the like we saw in 2011, for example, when we had China growing nominal US dollar GDP at 20% per annum. I think those days are certainly in the past now, and we are now back to what commodity cycles always used to be in that pre-China boom period. Periods where you had years of overinvestment, years of underinvestment, and commodity prices would tend to lag that. On the whole, I still expect to see demand growth relatively healthy over the coming 5 years, but I would be looking at a situation where pricing, well, we're probably going to be at or around current levels for the foreseeable future.
Roberto, back to you. Are oil prices really reflecting the dynamics of the oil markets?
Yes, I'd say basically they do reflect the forces of demand and supply. Actually, looking back at the big price fall of late 2014, I'd say the fall is adequately explained. On the demand side, consumption was stagnant because of weak economic growth around the world. And on the supply side, production kept growing year after year, and it was exceeding expectations. And the combination of the two forces have led to this new low oil price environment.
So, Colin, there is a view that U.S. demand is fairly robust and U.S. refiners have been buying crude. So do you think that oil prices may go up pretty soon from here?
I think you have seen the consumer react quicker to an oil price decline than you have in perhaps some of the other commodity consuming markets. And we are now looking at a situation where for the first time since the middle of the last decade, you may see US miles driven actually rise. Now, some of the pull through from the refineries is more a rebalancing, I think, to the inventory chain. It's pulling through in crude inventory. You have seen, though, a bit of a build in the refined product inventory side. It's all still hydrocarbon units above the ground, and that is still a buffer to the upside. So it's more a case of when we work through that inventory. On our modelling, we would expect us to still be in an oil market surplus for around the next 12 months. Then we would expect to move into a cycle where we're depleting those inventories, and into 2017, we would expect to see upward pressure on pricing as inventory levels become low.
Right, but Roberto, have you seen this kind of a scenario in oil happen in the past?
What we're seeing now with this rebound in shale oil, unconventional oil supply, no, I'd say that's pretty unprecedented. I mean, in the US, you had several decades of decline, and then from 2008, there was a sudden turnaround, and production has gone up by about 75% since then. And that's a result of new technologies. Well, in fact, they're not new, but they've been perfected about the turn of the century, and the technologies are being used in combination. Of course, I'm referring to horizontal drilling and fracking. And this is what has unlocked that huge resource wealth. So, no, this is pretty unprecedented.
Right. So talking about gold, it's obviously near its production cost right now since the prices have fallen so much. But the short position on derivatives is still very high. So where do you see gold going?
So in terms of talking production costs as a floor for gold, I've always struggled a little with that argument. I do think that gold miners themselves still have a lot of potential to take costs out of the system, should they need to. In gold, though, what are we looking for? We're looking for what level you stop seeing macro asset allocation away from gold, and also the level where you might expect some more consumer demand to step in. In fact, this has been the lack of consumer demand that we've been slightly surprised at in gold. We knew it was likely to be under pressure given the forthcoming Federal Reserve hike, and this is the time period where you were going to see macro asset allocation away. We haven't seen that micro asset allocation step in. Countries like India and China have disappointed in terms of their underlying gold demand. Now, where those countries step in would be one way of looking at a floor. The other way of looking at it would be at what level do we start to encourage commodity asset investment back into the space? Or at what point do people say, well, if I have a lack of other investment options out there, gold actually looks good to me? You can look at it in various metrics. I personally would be surprised to see the gold price fall below $1,000 an ounce. I do think there will be emerging market consumer support for it above that level.
And so what is the price you're looking at for gold for the next, say, year or two?
So we actually think that the gold price will continue to be under pressure until the Federal Reserve hike. We think that will come through in September. Actually, the last time the Federal Reserve raised interest rates, the gold price actually moved upward post that time. We're of a similar view this time. We actually think that long-term bond yields will peak out lower than maybe the general market expects. And with that, the gold price will also bottom. We'd be looking at the gold price actually around $11,000 an ounce, maybe $1150 an ounce over the next 12 months.
Colin, now I wanted to ask you about other commodities, particularly agri-commodities. They've been taking a beating as well, despite rising food demand from emerging economies. Why are the agri-commodities behaving the way they are?
So we've had a couple of years in agricultural commodities where we've had extremely good yields across the world. Not only has the global farmer been planting more land, they have also been applying more fertiliser to it, and the weather has been favourable. Now, as a result of that, whether we look across those key grains and oilseeds, or we look to some others like sugar, we do have ending stocks which are extremely high in historical terms. Given that there is no pressure there for the retailers to become aggressive on agri-commodity prices, and it's really only a weather event, I think, that could scare them into action.
So do you see these prices stabilizing over the next few years? Because this is really hurting the Indian farmers.
Yeah, you're absolutely right. Now, of course, the thing about agricultural markets is that you have effectively more or less a one-year capex cycle. So as farmers come under pressure, what are we already seeing? We're already seeing a drop in machinery sales, we're seeing a drop in fertiliser demand. That in turn will hurt yields, and that in turn will of course hurt overall production. So the agricultural markets tend to self-balance quicker than some of these other longer cycle capex commodities. We do expect to see actually global corn pricing start to move higher from the middle of this year. We do think, particularly in the US, you've seen a lot more acreage devoted to soybeans, which actually keeps some downward pressure on the soy crop. Now, farmers always have an option with what to do with their land, and I do think you therefore see that self-correcting mechanism kick in from this year. The global farmer, they will lose money for a year, maybe 2 years. After that, they will certainly reassess the business models and look at what crops they may plant to return to profitability.
Now talking about some of the ferrous and non-ferrous, iron ore and steel are down, copper is at a 6-year low, and the demand from China still remains weak. And there's a lot of dumping going on. Where do you see this dynamic changing and when?
In terms of the steel industry, the challenge is we may have hit peak steel in China. And our numbers we're not quite there, but we're certainly quite close. Now, if we speak to any Chinese steelmaker 3 or 4 years ago, of course they said, we're going to be so much bigger, we're going to add all this capacity. And that's what they've done for demand growth that hasn't come. And that excess capacity is now being walked out into the world, exported to everywhere else. We don't see any real end to that process unless we see aggressive acceleration again in Chinese demand, which is certainly not our base case. You're going to continue to see steel, aluminium exports at extremely high levels from China, pushing disinflationary pressures onto the rest of the world. Now that of course feeds back through the chain to iron ore. Iron ore is probably the poster child out there for overinvestment. We do now have a situation where Australia is shipping more than double the iron ore to the world that it did 4 or 5 years ago. And while China was growing, that was fine. Now that China is stagnating in terms of its steel demand, we have a situation where we again have to lose capacity from these markets. And I think for both steel and iron ore, producer margins will continue to be under pressure for years to come. We will have global overcapacity, and again, the only thing that could solve that is very aggressive and permanent supply cuts. And that may happen more in the developed world. I think for emerging markets where we are still looking at underlying consumption growth, that's always going to be a hard pill to swallow.
Colin, as you know, the dollar is inversely correlated to commodity prices and gold. So if the Fed raises rates and the dollar strengthens further, wouldn't that hurt gold and other commodity prices?
Well, we do not expect to see the dollar strengthen particularly much further. We think we've seen much of the strengthening already in a lead up to the Federal Reserve hike. Now, certainly, post that hike itself, you will see a bit more dollar strength. But in the main, we think much of it is priced in already.
And Roberto, how would you use that trade? If the dollar strengthens further, would you see the commodity prices and oil weakening further?
The U.S. dollar has been a factor, has had some impact on oil prices. I think it's a minor effect, really, and a very short-term effect, really. Overall, I think, though, the effect on prices are going to come from the fundamentals, from demand and supply. That is what will determine equilibrium market oil prices around the world.
And Colin, where do you see oil prices over the next few years?
So very near term, we see further pressure on oil. We think we'll hit the nadir around about the August-September mark, and that will probably coincide with peak production in the world globally. We would expect, I mean, given we're talking a large inventory buffer, we're looking at pricing just above the $50 per barrel level on a Brent basis through the coming year, and steady recovery from that point through 2017. Looking at a long-term normal of around 85, but that will be 4 or 5 years away.
Roberto, as you know, the World Bank has revised its forecast on oil, and oil gurus have also done the same. What is your view then?
Yeah, this has happened before. There's always predictions of prices skyrocketing, and it's usually because of a shortage. The experts think that there will not be enough oil to satisfy growing demand. But as I've mentioned, the main reason why I don't think that's true is that I think there's a very good chance that the rest of the world will be able to replicate to some degree what the U.S. has done with shale oil. And the rest of the world has a much larger global shale resource endowment. So, I mean, if they're able to do this, even at a much slower speed and at a later point in time, nevertheless, the impact on global oil markets would be pretty huge. And that would be a price-depressing impact.
And Roberto, finally, from an India perspective, oil is a big part of Indian imports, as you know. How should policymakers plan their budgets around oil?
Well, overall, I think because of these low prices that I envisage and the ample supply, this yields very positive benefits to major consumers, and India is prominent among those. So I think from that point of view, it will have a positive effect for Indian economy, for trade balances, and actually for the world at large as well.
Well, thank you both for joining us today. From the discussion, it appears that the demand-supply dynamics favor lower prices of crude, gold, and other commodities. I have Manisha Gupta from ET Now joining us right now, and she's going to give us some data points on this subject. Manisha, what is it looking like to you in terms of the historical ranges and future estimates?
Well, thank you so much for that, Punita. Well, yes, we have seen most of the commodities trading at multi-year lows. Many of them are in the bear market as well. And even as they show oversold on charts, the momentum is still on the lower side. Most of the experts in the global markets and India will tell you that the prices are expected to remain subdued. Of course, there are some contrarians as well, but you have seen a bearish report come in from Goldman Sachs for $45. Citi, of course, has been most bearish, calling crude at $20 per barrel on the lower side as well. But there are others who feel that you might see prices just weaken here on, but in next 5 years, the $100 per barrel could be back. Having said that, we are looking at higher supplies, low demand yet from most economies, and that tells you that the demand-supply imbalance may perhaps spill into 2016 as well. And it's not just crude oil prices. As per your discussion, we have seen the gold prices decline quite sharply as well. The Fed rate interest hike is something that the markets are keenly keeping an eye on, and most of the people are calling $1,000 per ounce as a support target on gold as well. Take a look at the base metal space, and that also see further declines. Another 5 to 15% of a cut in many of them also is not ruled out by the experts. And then again, it's not just the non-agro space. In the agro space as well, you are looking at higher supplies. The sugar prices globally are trading at a 6-year lows and thereon. So it really is a view coming across that for some more time, at least for next 12 to 18 months, you are looking at perhaps weaker prices in commodities going ahead. But Punita, that's about the commodity prices. I want to ask you on where do you see a connect coming in? Because all of these asset classes are fairly connected. The producer countries are facing a very difficult time. But when it comes to consumer countries like India and others, it really is a good time for all of us. Do you see the equities and commodities, the kind of relation that we have right now, continue going ahead?
Well, first let's just look at where we stand as a country in terms of our imports. Oil and gold amount to a significant part of India's current account balance and India's imports. And if you look at it as a percentage of GDP, oil used to be about 9.9% of GDP a few years ago, and that's actually fallen now to about 5.5%, and gold and silver were about 2.8 to 2.9%. They've fallen to about 2.2%. So clearly, as a percentage of GDP, we are seeing the importance of oil and gold reduce as prices have fallen, and that's very positive for the Indian economy. And if you look at India's trade balances, India's trade deficit is also reduced because of oil and gold prices having fallen. And in terms of, if you look at where the oil prices have fallen, as you've shown, they've fallen about 48%, and India's current account deficit has fallen by about 30-odd%. So clearly India's economy is benefited. But then if you look at the stock markets, has it all reflected in the stock market and equity market prices? To some extent it has, for India in particular, because if you look at the Sensex, where it was a couple of years ago and where it's today, we've seen about a 30 to 40% increase in the Sensex. But I wouldn't say all of that has come from falling oil and gold prices. We've also had a new government and an election during this time. So there's been some of that effect as well into the equity market increase. In fact, I would have expected with the kind of fall we've seen in gold and oil and other commodity prices that Indian equity markets would have rallied even more strongly, but they haven't. So the correlation is there, but it's not as tight as you would expect it to be. But that's it. Thank you, Manisha, for that. That's it on this show. On that note, we wrap up the episode of Global Insights with Punita Kumar Sinha. We will come back next week and talk about technology and where does India's potential stand in this global tech revolution story. Is this a boom or a bubble? We will try to find an answer next week. Thank you for joining.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.